It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast for our non-stop marathon all the way around 2025, as we say, and the year is starting to close on us. Breaking down for you the Australian property market. Always, isn't there? Something is going on. Thank you for the emails that we get on a regular basis. A lot of them just letting us know where you are listening in the world to us from. Don't be shy. We love getting the emails, and you can also these days leave a voice message. This is this new service that we now provide, which is in the show notes. So just below in the show notes, you'll find that recording device and it will get to us. We can feature your voice like Anthony Landau, who is coming up in just a moment. It is a Saturday, another weekend. Good luck if you're out there chasing property. It is November the 8th. You know, just weeks ago, a Melbourne Cup rate cut and the promise of more in the new year almost felt inevitable, didn't it? But the latest inflation figures came along and that completely changed the game. Not only was a November rate cut taken off the table, but any talk of easing in the near future has quickly vanished, which I mentioned a couple of days ago to Emma there in Adelaide. So what does this shift mean for Australia's housing market and the strong price growth that we are currently seeing? Well, let's go to Sydney right now and catch up with Anthony Landau, the Managing Director and Broker from Equilibria Finance. And before we get to all of that, Anthony, I want to go back a few days to the Melbourne Cup on Tuesday. Always interested if anybody has backed a winner. Apparently, you were a winner.
Good morning, Craig. Great to be here, and not an easy race to pick, and I certainly wouldn't call myself a seasoned punter, but somehow, out of all those horses, one that me and a couple of mates picked brought home the bacon, so that was a bit of fun on the day.
Come on, how much money did you walk away with?
Well, we had a pool of money that we split up, so let's just say, given the odds, we tripled the money we chucked in, so that was a nice little earner for the day, but as I said, I'm certainly not a punter, just a bit of fun once a year.
It's not very often I'm talking to winners when it comes to the Melbourne Cup. Now, let's get on to these rate cuts. You and I were talking about this on Tuesday. We're in pause mode. Perhaps people may well ask themselves what's behind these persistent price pressures that seem to be keeping inflation higher than expected.
Yeah, really good question. And what a massive couple of weeks it's been in terms of the inflationary data and interest rates. As we touched on, the rhetoric has shifted from more rate cuts to potentially we're stuck on this cash rate of 3.60%. Some economists are even talking about a rate rise in the new year now. That inflationary data that came through a week or two ago, the headline inflation now at 3.2%. That's up 1.3% for the quarter. The RBA target range is 2 to 3%. We are now sitting right on that or outside of that. It's the biggest annual change in 12 months since September 2024. That led to the cash rate pause, obviously, on Melbourne Cup Day, and more to come on those, I believe now. The biggest drivers are domestic demand, and that's a concern for the RBA governor, and they're not sure how temporary they are. The biggest culprit, electricity prices are up 23.6%. on the 12 months. Eggs, tobacco, they're both up over 12%. Education expenses are up over 6.4%. Annualised housing growth is up 6.1%. A lot of the increase is on domestic-focused consumer demand, and that is probably the concern of the RBA.
You did hear him right. Anthony just talked about perhaps next year a rate rise, not a rate reduction. And of course, when it comes to the first home buyers scheme, boy, that is a shot right across the bow of these first home buyers that are going in on a 5% deposit. How much more we're going to hear about a rate rise is anybody's guess, but it is in the open now. You know, I mentioned, Anthony, a few days ago that many earners like nurses and teachers would end up spending 70 to 80% of their income on repayments under the scheme. And I pointed out, you know, these professions, they already, don't they? They carry a massive workload stress. So we don't need our teachers, our nurses, our police force to feel more stressed out with these mortgages, let alone the rate might actually increase.
Yeah, well, they're our essential services, aren't they? And they, like many, are now having a much larger proportion of their salary going towards a mortgage. And often for a policeman, often for a nurse, often for those essential services, they have to live in a specific area, in a city, in a capital city, or in a region that's quite populated. And they're often in a market with a lot of other first home buyers or investors. So a real challenge for them. But we're seeing that across the board. A lot of people now are paying over 50% of their take-home salary on their mortgage. That's only exacerbated in some of those essential services, as you noted.
Now, if you are in one of those professions, we would love to hear from you either by way of an email or the voice recorder. Let us know just your thoughts when it comes to a possible rate rise and that 5% deposit. Now, the cash rate is the RBA's key tool for managing inflation, but how closely have recent inflation trends and rate movements really aligned? I'll ask you this, Anthony, have higher rates had the desired effect, or are we seeing a lag in results?
My view, and I think a view that's starting to trickle through, is yes, there may be a lag in results. We've had 75 basis points cut since February of this year, bringing our cash rate to 3.6%. We had inflation seemingly back within target range over the last couple of months, but now back above at 3.2%. Yes, there may be a lag of sorts. However, I think there's actually a recalibration of some of the thinking. There was a lot of talk that a cash rate of 3.35% or 3.1% would be what's seen as neutral, where we're sitting in our inflationary target and the cash rate's sitting at a steady rate. There is now some talk that maybe 3.6% or even higher is going to be needed to bring that inflation back under control. The governor didn't specifically say there would be a rate rise in the future, but she certainly didn't rule it out. So that is getting some economists talking about, will we see a rate rise in the future? If nothing else, I think we're stuck on 3.6% for a while.
It is Anthony Landau on our Saturday morning property show. We'll come back in just a moment with more thoughts around the RBA and the cash rate. We'll do that next.
Every morning from 6 a.m, we bring you the latest real estate news with diverse perspectives from leading industry experts. We deliver the most property podcasts across Australia every week.
And right now it is time for another property tip. We were talking to Jake McIntyre a couple of weeks ago there in Melbourne. Let's go back to him because, Jake, you've got a property tip for us this morning.
Absolutely. Property tip for today is bid confidently and quickly up to your budget, but also maintain eye contact with the auctioneer so he knows exactly what you're planning to do.
Yeah, because sometimes people can be looking around at their competition. If they've got those eyes open wide, it's kind of a giveaway telltale sign.
It absolutely is. And as an auctioneer standing in front of everyone, if you're looking at the ground or looking around, I don't know what you're going to do, and I could knock it down before you even make your last bid. So make sure you're looking directly at the auctioneer if you intend to bid.
You're listening to the Saturday Property Market Update.
And it is a Real Estate Saturday. Yes, good luck if you are out at an auction today. Make sure that you are bidding strongly with plenty of confidence. And yes, just keep going until you hit your ceiling. Make no signs that you are weakening until you actually hit that price point that you can't go on any further. Now, Anthony is with us, and we're going to have a look at when you compare Australia's approach to other major economies, how does the RBA's response stack up in 2025? Do you think that they struck the right balance between cooling inflation and supporting growth? What do you think?
Yeah, it's a really good question, and it's easy to look back in hindsight, but inflation in Australia peaked and around a lot of other countries back in December 22. Inflation was at 7.8%. At this stage, our cash rate was at 3.10%. So it was well up on those cash rates of 0.1% we saw back in 2021 and 2022. But it's all about the response. Our cash rate rose to a peak of 4.35% over about a 12-month period. But within that same time frame, some of the other economies that maybe we look at, the US, the UK, Canada, New Zealand, their cash rate went up over 5%. It went up further and it went up stronger. Now, it could also be argued that they have inflation more under control now. New Zealand's inflationary rate is now at around 2.5%. The UK and the US around about 4%, but for them, it's been fairly stable, it's been fairly steady. From that perspective, I think there is an argument that maybe we didn't go high enough and we were too slow to react when inflation was getting out of hand.
Yeah, no, there's quite a bit to think about between now and the end of the year, and then, of course, going into a brand new year, which gets me on to this talking point, and that is the housing market has been in this continued powering mode, full steam ahead, and with the RBA now pausing and inflation showing these signs of persistence that you're talking about, what do you think the impact could be on prices and buyer confidence as we project into 2026? That is fast racing up the outside like your winner from the Melbourne Cup.
Yeah, it's closing in, isn't it? It's been a buoyant market, absolutely no doubt about it. A lot of that buoyancy was created from the rate cuts. A lot of that buoyancy was coming from investors back in the market. A lot of that buoyancy was coming from first home buyers looking at opportunities now that they had those rate cuts as well as the 5% deposit scheme. I think the wind's going to come out of the sails a little bit. I don't think we're going to get negative growth. What I think will happen is we're going to get the rate of growth slowing down. Annualised growth nationally has been at 6.1% to October. And the October national dwelling values surged 1.1%. That is the strongest monthly gain since June 2023. There was a lot of emotive behind that. There was a lot of logic behind that in terms of borrowing power, but the market was on the run with the expanded deposit scheme and also with investors coming back into play. I think that rate of growth is going to slow. I think some of that sentiment around what's to come, are we going to get future rate cuts, is going to have an impact on the market. However, we're still going to see strong demand. We're still going to see growth in the markets. We're still going to see a lot of activity. We're hearing nothing that's being talked about is addressing the fundamental issue in our housing market, which is supply. So while ever that's sitting there, we're going to have good, strong growth across the housing market, which does make affordability an ongoing challenge for a lot of people trying to get into the market.
Good on you, Anthony Landau. You enjoy your weekend. There is plenty of thought going into some of that prediction into next year for 2026. And thanks for coming back onto the Real Estate Breakfast. Catch you back in a couple of weeks' time.
Looking forward to it. Great to be here and have a nice weekend.
From the emotion of property, the economic inflation, managing your expectations, lack of stock, price growth, construction appetite, days on the market. Stay informed with us and know your property.
But in this market, loyalty generally doesn't pay, which is why it's important at least every couple of years to look at the rate you're paying, use a comparison service to see what the lowest rates in the market are.
Yeah, and if you're one of these people that think, yeah, I want to remain loyal to my bank. My bank has been fantastic to me over the last 10, 20 years, whatever the case may be. Get out of that way of thinking, because your bank is not loyal to you. You've got to look after number one. And again, that loyalty factor, it's a bit of a mystifying thing how people sort of get sucked down the rabbit hole of being loyal to their bank.
Yeah, I think it's an old-fashioned thing as well. So we tend to find with Finder consumers, those above 40 tend to be, and I'd be in that group, tend to be more loyal and stick with the same bank, and those under 40 tend to be far more likely to switch, and therefore far more likely to get the lowest rate. And this doesn't just apply to home loans, credit cards, personal loans, even broadband packages, phone deals, all that kind of stuff.
We connect you to the best real estate information across Australia. The Real Estate Podcast.